Hello, I'm Mitch Goldberg. Welcome to my live stream, Be the Boss of Your Money. The show is about you taking control of your money because it's very easy for your money to take control of you. The goal here is to put the personal back into personal finance, to teach you the strategies and lessons that I've learned during my career, which spans over 30 years as a financial advisor, so that you could improve your life with money, your relationship with money. Yes, it's a buzzword, relationship with money, but it's true. So that's what the show is all about. Be the boss of your money. Welcome. Today's big topic on Earth Day on April 22nd is ESG investing. If you haven't heard, ESG is all the rage on Wall Street with consumers. It's environmental, social, and governance investing. Companies that get high grades in those areas. Who makes the judgments in these areas? Lots of companies are now in the business of making very strong judgments about who deserves a high ESG rating and who doesn't. But I've discovered a few things along the way that kind of tells me that maybe ESG investing isn't really all that it's cracked up to be. But I did find one particular ESG ETF that has really risen above the din. So let's get into it. We're going to roll a quick introduction. We're going to talk about ESG investing on Earth Day. It is definitely the right day for this topic. Stick around. Going to be good. Welcome to my live stream. I'm Mitch Goldberg. You're watching Be the Boss of Your Money. This is my live stream all about personal finance. While you're watching, if you have any questions, certainly ask me in the comments. I love hearing from you. Words of wisdom, sharing lessons that you've learned along the way. Those are always appreciated here. And if you're watching this in the replay, welcome to you as well. Certainly, if you have any questions, you know what to do. Ask me in the comments. I will see those questions, and I look forward to getting back to you. So thank you very much for joining me. Today's big topic is ESG investing. Is this like a marketing pitch that just investors can't resist? You know, investing in companies that are making the world a better place, that are making the world cleaner, lowering pollution. Or is this just kind of like another marketing gimmick to repackage the same old stocks with a new fancy label and then sell it to you, the same thing that's been sold to you over and over and over? And you could have just bought an S&P 500 index fund and gotten the same stocks, and even for a lower fee, right? By the way, an index fund, you can't invest directly into an index, but you could invest in a product or security that tracks or mimics an index, which is called an index fund. Okay, so let's get into it. We've got a couple of things to go over. First, we have to go over why the market took it on the chin today. By the way, folks, I see your comments coming in. Thank you very much. I'm going to address those in a little while, but I want to get to the heart of the topic. So the first thing we like to do here is we like to do a share screen and show you what happened. Today was significantly it was down significantly enough to warrant a quick review of what happened in the market. So let me put myself up in the screen. Okay, I'm here in the corner. Hey, yo, up in the corner here. Okay, so the Dow, as you can see, okay, hopefully you can see that on your smartphone, but the Dow down 321 points after being up a good chunk of the day. NASDAQ down a whopping 131 points. Interesting to say that the NASDAQ, S&P 500, and the Dow were all down by just about the same exact percentage amount, about 0.9294%. Gold off a little bit, 0.5%. Oil up a little bit. Nothing crazy. Oil's been pretty much flat, low 60s for a while now. 10-year continues to drift lower at 1.5%. We were all worried a month and a half ago that, the 10-year treasury broke through 1.6, then 1.7%, and it was going to fly to 2.5. And all of a sudden, yields keep coming down, and Yet we see better improvement in employment figures and rising inflation numbers. Go figure, right? The VIX was up a little bit at 18.71, not too far from breaking above 20. Let's take a look at the cryptos, okay? Crypto had a tough day, down about 6% on Bitcoin, and the others were also down. Ethereum out, I beg your pardon, Ethereum was up. Litecoin was off a little bit. These are just the most popular traded. Dogecoin, that's actually been coming down pretty hard, but down 13% today. Dogecoin is giving back a lot. I read an article in, I think it was Business Week, that 6 holders of Dogecoin hold like 80% of it. So if just one of those investors decides to get out, it could become a stampede and make that even lower. Sometimes you have to know who your partners are when you're holding any kind of security or crypto. So overall, though, a pretty rough day in the crypto world, but the heavyweight Bitcoin down 3,000, down 3,200, down to about 52,000. Okay. So let's get to the heart of the matter. All right. So we're talking about ESG. Is it everything that it's cracked up to be? By the way, I see you out there, Michael, Michaela. Thank you so much for joining me. And while we're here, let me check here. We've got Bill out here. Hi, Mitch. Good to see you. Very good to see you too, Bill. I haven't seen you for a while. So, great to see you. And I really appreciate you stopping by. Yes, I know. Listen, not everybody could just stop what they're doing at 4:30 late afternoon to watch my show, but you could listen to it while you're in the car or just play it in the background. But I get it. So thank you very much. I really appreciate you stopping by. By the way, if you're watching this on YouTube for compliance reasons, I cannot accept the comments through YouTube. So if you are watching through YouTube, I appreciate it. But if you want to comment on the show, you have to do it either through LinkedIn or Facebook. So you could check out my Facebook page, Client First Strategy. If you know me personally, you could check out my personal profile and connect with me there, or LinkedIn, Mitchell Goldberg on LinkedIn. LinkedIn, by the way, is my main social media platform. That's the one I spend the most time on. It's also the one I enjoy the most, and I've made a lot of good friends there. So I love LinkedIn. So if you're on LinkedIn and we're not connected, definitely send me an invitation to connect. I'd love to connect with you. Okay, so let's talk about ESG. So the overarching thing is this. ESG investments usually get high remarks because of what they're not. They're not oil stocks, they're not energy, they're not industrials, typically speaking. All right, they're not typically smokestack companies. They're not, they're not coal miners. Obviously, they're not any kind of miner. So that is really what makes an ESG investment what it is by looking at what it's not. So what happens is you take a look at the what is often included. Okay, so what happens is if you take a look at what's included in ESG, after you get out of smokestack type companies, a lot of the economically sensitive stocks like energy stocks, then you move into companies that are either in technology or finance, companies that don't really, get their hands dirty. Okay, companies that don't make things that if you drop what they make on your foot, it'll hurt, right? They don't make these things. So ESG has a very heavy bent toward high technology, so tech, and then a lot of innovation type companies. And you might think, well, innovation is great. That's where you get the growth from, except that you also have to know that, typically speaking, a lot of innovation companies are the highest priced, most richly valued stocks often. And these are also the ones that if they miss on earnings or if they miss on a patent or if they miss on a new product, these are the stocks that often could get hit the hardest as well. So, you have to take the good with the bad, but that is often a place of high potential gains, but high potential loss. And then you have just this overweighting in technology stocks. And I find that if you look at like the S&P 100 or the NASDAQ 100, and then you take a look at the stocks that are in most of the ESG ETFs, they're remarkably similar on the broad-based ESG ETFs. I mean, if you get into something specific like, artificial intelligence or solar stocks, then the equation shifts. But when you look at ESG, there are a couple of things that you have to take a look at. And so ESG could include companies that promote women to the upper ranks of the boardroom, all the way up to CEO, chairman of the board, et cetera. Then there are companies that create, for example, that build electric cars. So we know who they are, the Teslas of the world, the Neos of the world. And then there are companies that are in ESG that maybe produce solar panels or install solar onto roofs. So you could slice and dice ESG so many ways to literally turn anything into ESG. If an energy company has a CEO who is female, is that an ESG company? Should you buy that because you want to invest in companies that are good for Mother Earth? Because that's the main topic today, Mother Earth. What's, investing in companies that don't hurt Mother Earth, right? So you have to think about that. So, it's very tough for me to get my hands around a company that might be polluting the world, but because they have a female at the head of the company, that it's ESG, and vice versa. Just because a company, for example, is in energy doesn't necessarily mean that it has to not be ESG. So what I want to do is I want to take a look at some of the ETFs that I've been looking at that have been around for a while. One of them, the symbol is SHE, SHE, and as the name would imply, it's companies that, let me share the screen here. Okay, as the name would imply, it's companies that are very focused, that promote women to the upper ranks. So if you take a look at SHE, this is an ETF, and this is done very well, but 28% of it is in technology, which is not too dissimilar than the S&P 500. Consumer cyclicals, which is consumer discretionary. There's some industrials, but look at the companies: PayPal, Texas Instruments, Disney, Visa, Johnson & Johnson, Netflix, Wells Fargo, Intuit, Square, and Nike. So the top 10 holdings make up 40% of the ETF. That's considered a pretty concentrated fund product. And you're basically getting a lot of the same companies that are in the S&P 500. And then you take a look at one of the biggest ones, Vanguard ESG US Stock ETF. Okay, let's just take a quick look at what's in this one. Okay, so just about 40% is in technology. And the reason for that is because once you start eliminating what is not ESG, you're not really left with that big of a universe of stocks to pick from. So you wind up with ESG investments that become very focused or very concentrated in certain areas like technology. So if you look at this one, the biggest holdings are Apple, Microsoft, Amazon, Alphabet, Facebook, Tesla, JP Morgan, Alphabet, again, that's Google, Visa, United Health. This is remarkably similar to just the S&P 500 index. So if you are comfortable buying, forget ESG, if you're comfortable buying an ETF with an even greater concentration in technology than the major benchmark, the S&P 500, then go right ahead. But my whole point is, a lot of people would buy this ETF and say, this is the one that I want. It's a big ESG ETF. If it's not the biggest, it's one of the biggest ones, has, in terms of how much assets under management it has. But you have to accept what it really is. Forget the name ESG. So if you forget the name ESG and just look at what's in it, you're basically buying a portfolio that is just about 40% in technology. Do you think that is a good place for your money? Now, I'm not here to judge that. Now, I mean, I know what I would tell my clients, but it's on an individual basis. So for a lot of them, no, this wouldn't be appropriate. For some of them, maybe. Most, I don't think so, because if I want more technology exposure, I have other places to go for technology exposure, like a pure sector ETF in technology, if I want to add more technology exposure. So I think it's really important to know that. I think it's really important to know what you're buying. And when you're buying a lot of these ESG funds, you're really getting tech-heavy funds. So ESG funds that have the name ESG, the letters ESG associated with them, they've done very well. So people say, look, ESG is a great way to go. It's better for the earth. I feel better emotionally about my investments. But the reason they've outperformed is because they're overconcentrated in technology, which in the last year is a sector that has outperformed. Ever since we went into the pandemic a little bit over a year ago, it's been all, the leaders of the market have been tech stocks or tech-related stocks. So you have to accept that when you get into this, you are getting, a big slug of the same stocks that you could just buy in an index fund. And even though this expense ratio is 0.12%, which is rock bottom low, you could get, S&P 500 index funds for, believe it or not, a lot lower than that. I don't want to make too big of a deal about that. All I'm saying is this: if you really are interested in becoming an ESG investor, I actually think there are better ways to go about it than buying the available ETF and mutual fund products that are on the market today, because they have such a high concentration of technology. So of course ESG has outperformed the benchmarks, because if you load something up with the best performing, hottest stocks, that's what will perform. And we'll take another one. I'll look at another one. This is the clean energy ETF. Okay, it's a very popular one. Plug Power, Enphase, Verbund, Vestas. Some of these I've never heard of. We've all heard of Plug Power, hydrogen, but almost 50% of the portfolio is in 10 stocks. So I would say that this is probably pretty aggressive, bordering speculative. But you see, it's clean energy, and you say, well, clean energy is great. And that's the problem I have with a lot of these products, is that they're just packaging the same old with a different wrapper on it, a different name, and they're reselling it to the public again. And I have to say, it kind of turns me off. So for these reasons, when it comes to ESG investing, I don't think it's all that I don't think it's everything that it's cracked up to be. But I also don't think that most consumers really know what they're buying when they buy a product with the label ESG. You're basically buying the highest priced stocks, and the more money that goes into these products, the more the stocks go up, and the more that impacts the other products that are investing in the same stocks. So the demand for these stocks is there because they're going up. And because they're going up, it creates more demand, which means it's just a self-feeding frenzy on the same sector, to the point where I think a lot of these stocks may very well be highly valued, even overvalued. And you've got to understand as an investor that when you're buying ETFs or other products that are associated with the term ESG, environmental, social, and governance investing, that you must accept the higher risk that you're taking by not only getting into highly concentrated investments in the tech sector, but they are also in many ways duplicating the biggest positions that you have in your other investments, because your other investments are also loaded up on the same stocks. So you're not really buying something additional to what you already have. I don't think ESG investing is really providing you with more diversification. Diversification, that's a strategy that we use to mitigate risk. Doesn't necessarily protect your portfolio in a generally down market, but it could help prevent your portfolio from being overwhelmed by the worst performing investment you have. But you're not gaining more diversification with the ESG funds, at least the ones that I'm looking at. I look at a lot of them because they're so concentrated in the same stocks, and they're just duplicating the stocks that you already own in your other investment products, your other ETFs and mutual funds, especially when you compare these to something like the S&P 500 fund. So that is my big beef. Now, I want to just point something out here because, believe it or not, one of the things I get to do in my day job is write a couple of articles for CNBC. I've written many of them, and I want to share something I wrote to you about the subject. So I'm not new in the ESG subject. I've been following this area. For a long time. I'm not a newbie when it comes to understanding ESG investments. And I did write this article a long time ago, and I just want to show it to you. Okay. And you see it on the screen here. I wrote this. When did I write this? See this by Mitch Goldberg. I wrote this November of 2019. So, about a year and a half ago. Okay. And what I said here is investors, you see, I'll just highlight this. Investors need to be aware that ESG bets can be concentrated in certain stocks and duplicate existing market holdings. That's exactly what we've been talking about. So I was definitely early to this, and I'm not knocking it. Again, if you want to invest in funds that have eliminated the worst polluters of planet Earth, I get that. You don't want to buy a chemical company, for example. You don't want exposure to it. You don't even want to put any money in it by accident by buying, an ordinary S&P 500 index fund, for example. Then, hey, I get you. No knocking it. The only thing is, I don't think people really understand what they're buying when they're buying ESG investments. Okay. So let's take a look at something here. They appeal to millennials, to Gen Z demographics. I think they appeal to everybody, though. I'm a Gen Xer. I think they appeal to Gen Xers and boomers, but we're all investors, and we're all trying to do the same thing. So the Vanguard ESG ETF has a 28% sector weighting to technology. Well, that is now like 38%. So just to give you an idea of how that's changed, because technology has gone up so much. So the technology stock problem, outperformance and underperformance, always need to be examined. And there are likely two reasons why a fund could outperform its benchmark, either by outweighting the outperforming sector or lowering the expense ratio. In the case of ESG, it looks like the answer is an overweight to the technology sector. So, and there's Insight Shares LGBT Employment Equality ETF. There's the Impact Shares YWCA Women's Empowerment ETF. There are a lot of ETFs, and I want you to know. I mean, I wrote this in here, so I'm just scrolling down real fast to say, if you feel it's important to invest using an ESG or SRI, social responsible investing approach, it isn't a bad way to go. This category doesn't have a long enough track record to either prove or disprove the thesis that it could be better or worse. But what we know for certain is that, like all investment strategies, no one approach outperforms forever. And when strategies do work, it's as likely to be because of the external market environment as a fund's unique objective. And as long as the tech sector continues to lead the stock market higher, then I'd expect this class of funds to continue to do well and attract more investors. Okay. And I just want to say, feeling good about how you're investing is a legitimate starting point, but it's not an end unto itself. Listen, I believe in personal finance. I believe in putting the personal into personal finance. Okay. And I am, I have no problem with any of this stuff. Um, and I'm just looking for where I want to do. You know what I'm going to do? I'm going to put a link in the comments of the live stream for you guys to take a look at. So I am pro equal rights, pro LGBT, I'm pro everything. And I have no problem with this stuff. But what I want you to know is simply, just to reiterate, ESG is one thing, but it's very hard to actually pick an ESG fund that is giving you something you don't already have with your other investments. And if you are adding a new investment that is similar to your other investments, you're not buying a new or different investment. You're not investing in something new or different. You're just buying the same thing over and over again. And to me, that flies in the face of important portfolio metrics like diversification. So that's my thing. I see Mark is out there. Mark, hey buddy. Hi Mitch, miss you. I miss you too, buddy. I'm hoping to get back to the gym in a couple of weeks. So I hope you're taking good care of the place. Tell everyone there I say hello. Judy's out there. Okay. And that's about it. So I will see you Thursday. I don't run the show on Fridays because I turn out a really good email blast. And if you want in on that and you'd like to receive that, let me know in the comments or something, or just say email blast and I will reach you to get your email address so I could add you to that. There's nothing salesy about it. I don't share my email list. It's just something I use for my own email distribution to my network. Okay. Thanks so much, guys. I hope to see you. I'll see you Monday. And if connect with me on social media. All right. That's it. Take care.